Zero coupon bonds. We're going to talk about this. I've always been a huge fan of zero coupon bonds because of the simplicity of them. It doesn't get much more simple, and they're safe. So let's talk about them. I shared a story when I was 93, 94, when I was working at a bar in Arlington, Virginia, when I was still in college. One of the managers named Paul, a guy named Paul, and he was a rugby player. And I like Paul; he's a good guy. But he'd have a friend, a stockbroker, come in, and we just talk about investments and whatnot. And I know the first thing about him. And Paul told me, he goes, and we just got talking. He bought a zero coupon bond from this guy. I said, I don't get it. How's it work? He goes, well, basically you put in $75,000 or $7,500 or $750, whatever, and you get $1,000 back at maturity. I said, that's it? He goes, yep. I said, there's got to be something else? He goes, nope, that's it. So let me show you. A zero coupon bond, you literally get no coupon. In the old days of bonds, they have coupon clippers. You would have this, you get this bond issue. They have like these 10 coupons on there that all prorated, whatever it's called. And you pull it off and you take it to the issuer, the bank, or send it in, and they'd send you a check. It was literally that simple. And that's way in the old days of the bonds, literally with coupons. You clip the coupon and send it in and get your money. So a zero coupon, there's no coupon. It's literally zero. So what you do is you buy $7,500. And then in 5, 10, 15 years or something like that, you get $10,000 back. That's it. Now there is some phantom income, you got to pay tax there and stuff like that. But I mean, and we weren't going to get that here today. But it's literally that simple. A lot of these are guaranteed by the government, and so you literally know for a fact I will get $10,000 back guaranteed. And so one of the strategies we used to do back in the day when I was a broker, which I love this strategy actually, I thought this is one of the most underutilized strategies ever. We'd take a guy with $100,000, so he had $100,000 in his account, and we would say, okay, you get $100,000. You don't want to risk anything, so we're going to buy a 10-year zero coupon bond. We'll say $65,000. This isn't working very well. Let's try this one here. This is a great strategy. Oh yeah, there we go. $65,000. So you get $100,000. We're going to buy a zero coupon bond for $65,000. And then we're going to take your other $35,000 and invest it. This strategy, my friends, is so simple and it's so effective because you can intuitively grasp it. That's the thing when it comes to investing. If it's not intuitive, it scares people. If it's intuitive, people get it and they're like, that makes me sleep better at night. All right, so what we're doing here is we're saying we're going to have your $100,000. We're going to take $65,000 and we're going to split it out and we're going to buy a zero coupon bond because we know for a fact, and we'll just use this for an example, in 10 years, this will be worth $100,000. This is literally how annuities insurance companies do this, by the way. This is literally what they do. So we're essentially skipping the middleman with the insurance company. We're going to buy a $65,000 bond and in 10 years it'll mature at $100,000. You have guaranteed not to lose any money whatsoever. Now, what do we expect to happen to this $35,000? Well, it's going to go one of three ways. It's going to go up, it's going to go down, it's going to go even. So if it goes down to zero, what do you have in 10 years? You get $100,000 guaranteed. If it stays even, this is such a good strategy. If it stays even, what do you have? Well, you have your $100,000 from the zero coupon plus your $35,000 from the stock account because it didn't do anything. It just stayed even. So you have $135,000. What if it doubles? What if it gets up 7.2%? Then you got $70,000. So you got $100,000 from your zero coupon and you got $70,000 in the investments because it doubled. So in that case, your $100,000 after 10 years, you are guaranteed. Hey, buddy. Hey. My man Pablo over here is barking because my wife just walked by. Pablo, it's okay, Bubs. So in 10 years, in this case, you are guaranteed to have either $100,000, no less than $100,000. You might have $135,000, or you might have $170,000. You're guaranteed, though, to have no less than $100,000. So you can sleep better at night. You say, look, at the end of the day, I'm getting my money back. No ifs, ands, or buts. No muss, no fuss. And I know for a fact that I'll either get my money back at $100,000 or I'll have $170,000 when all is said and done. If I take my Trusty Calculator and I say $100,000 today is my present value, $170,000 is my future value, no payments, and I do that for 10 years. Oops, $100,000. I would have made, oops, hold on just a second. Let me make sure I got to do that. Change that one, enter. Okay, cool. So I got $100,000 as my present value. $170,000 is my future value. I got 10 years. That's what I'm 10 years. Nope. My return would have been 5.45. That's not too shabby. 5.45. Now I would have had $170,000, and you would have had $200,000 if you got 7.2. But I had no risk, and so essentially I'm leaving $30,000 on the table. But I still got 5.45, where you got 7.2, but you had a whole lot more risk than I did because you didn't know if you're going to go down to 0 or if you're going to go to 200, where I knew I was going to go at least to 100. So a lot to be said about that strategy. It's great. So the question is, can you still work it? Well, let's take a look. All right, so we're going to go to zero coupon bonds. This is Fidelity. I'll put a link in the show notes. And we're just going to go to bonds. We're going to go down here to zeros. U.S. Treasury zeros. So I like U.S. Treasury zeros because they're guaranteed by the federal government. There's no riskless bond more so than that. It's the most risk-free investment you can make. So let's go to 30 years. We're going to take a 30-year zero coupon bond is yielding 2.08. Let's see what happens if we click it. I think I got to sign in. Yeah, and I don't have an account with Fidelity. All right, but we know we know for 2.08% is what my zero coupon bond will be for 30 years. So what I do is I go to this calculator, my zero coupon bond calculator, and you can figure it out yourself. You take your face value. We're going to say it's $100,000. You divide that by your by 1 plus your yield, which is in this case what I say 1.0208, 1.0208. And you factor that, or your exponent would be your time to maturity, in this case 30 years. But we don't have to do that. We're just going to use a calculator. So if we scroll down, we're going to say, yeah, forget all that. We're going to say face value is $100,000. What this will tell us is what our price of that bond will be right now. $100,000, what do we say, 2.08%, 2.08. Time to maturity is 30 years, and it's going to cost us $53,923 to get our money back in 30 years. So we know for a fact we will almost double our money in 30 years' time. Well, that's not great, but let's do something else. I mean, but you know that. You'd say if I put not double our money, but I guess would be. I'm putting in 53,000. I'm getting a little bit less than twice that in 30 years. That's not great. I don't like that. But what I would say is let's look at 10-year bond. 10 years are 1.63. So let's go back to the strategy I was just telling you about. So 1.63. Oops. And we got a 10-year bond. It's okay, buddy. So in this case, I put in $85,000 and I get $100,000 back. All right, so let's do this again. So in this scenario, and this is where you got to see, this is the stuff you got to realize. The low interest rate environments, and on top of that, this is where I don't want to say deflationary, but you just got to recognize that you aren't going to get a huge bang for your buck on the bonds, which means there could be some problems on the stocks because there's a little bit more higher valuations as well. We got high valuations on stocks, high valuations on bonds. So you got to squeeze out what you can. And this is one of the things you shouldn't invest in fee-based accounts because that is a significant expense that you just can't afford to take. You can't because you're not getting much. All right. So in this case, we have $100,000 that we're starting with. We put $85,000 in the zero, and we got $15,000 on the other side. All right. So we're going to invest $15,000. We know in 10 years we'll get our money back. So in 10 years, we know for a fact that $85,000 will be worth $100,000. That is no ifs, ands, or buts about that. The federal government will pay its debts. You can't get any less risky than that. I cannot stress this enough. But Josh, the federal government, I get all that. It's still the most risk-free investment we have. So we put in $85,000. 10 years from now, we get $100,000 back. What do we do with that other $15,000? Well, and that other $15,000, if it grows at 7.2% a year, it'll grow to $30,000. And that means in 10 years, you'll have $130,000. Again, $100,000, you split it two ways. You split $85,000 to the zero. You put $15,000 in the stocks. The $85,000 will become $100,000 after 10 years, guaranteed. The $15,000 may go to zero, might stay at 15, might go to 30, might go more. But in this case, we're just saying a 7.2% rate of return. And we know for a fact you'll have $100,000 because the zero is back to 100. plus your $30,000 of stocks, you'll have $130,000 in your portfolio in 10 years. Now, what is that rate of return? Well, we take $100,000 present value, $130,000 is our future value, and we calculate we've got 2.65% rate of return. That's a 2.65%. So essentially, what happened here is the zero gave us of that 1.63, but because 85% of that zero was in 1.63, the 7.2 that we got on the stocks was dwarfed. But we still know for a fact you're going to get 2.6, or not fact. We know for a fact you'll at least get your money back. But in this case, again, you'll get a 2.65% rate of return. Now, what a lot of people say, why would I even do that? Why not just go to CDs? Well, that's a good point. So let's take a look at what CDs are doing, because 10-year bonds, we got 10 years. Here's some corporates, 2.23. High rated corporates 2.08, A corporates 2.94. What I say we're going to get 2.65. So here you can see that we're doing better than the highest rated corporate bonds out there. We're going a single digit A, still investment grade, but even let's see, yeah. But I mean, so of all the bonds, we are going to do better than everything except for agencies. See, that's their Ginnie Mae's right there. I like that. 2.92. We're going to do better than everything except for the agencies, the single A rated bond, the low investment grade bond. Is the double A, is triple B, is that low investment grade? It's low investment grade, but I can't remember if it's junk. I just don't recall. But anyway, I think that is junk. And then down here at taxable municipal. So we're doing better than the bulk of the bond market out there, which would tell me we're going to do better than the bulk of the CDs out there too. That's, again, if that 15,000 we invested in stocks moves. So that's for sure. I mean, it could go to zero. Let's go to CD ladders. Yeah, even that one. Look at this. 10-year CD, 2.40. So we're doing better than a 10-year CD. 5-year CD, 2.15. So we're doing better than everything from the CD's perspective for sure. Why is he got? I don't get why he's doing this. So we got 1.75, 1.75. Oh, that's a ladder. Okay, gotcha. Yeah, Fidelity. See, Fidelity's sweet. If you're running your own money, Fidelity's tough to beat. It's better than Vanguard. Dude, that's new issues. Look at secondaries. Will it make me log in? I bet it will. Let's see what we got here. Secondary CDs. There we go. Let's do mature date 2000. We'll say 2024. Oh wait, I say it's 2019. We'll go here. I wonder if I can do any here. Let's see. Let's do 5-year CDs. We'll say 09 September 2024. There we go. Let's see what we come up with. It'll be 5 years. It might work. Oh, there we go. Okay. There we go. All right. Well, it's 3,000. Man, so they got a lot of CDs here. So let's we'll say 2029 then. That should eliminate some of this, I would think. Oh man, nope. Wow, let's go. I see the ones. Let's just go here. Let's say 2. There we go. Okay, so let's see what we got here. These are 10-year. Maybe log in. All right, so scratch that. But anyway, so what's happening here is the zeros allow you to take some risk with the stocks that you might not want to. That's for sure, which I like. Actually, let's just see new issues here too. Let's see what they got in the new issue area. Still make me log in. Oh, because new issues, they want me in their system to sell me stuff. Let's just try that again. Yep. All right. Now let's try annuities here. Let's see what we got. Ooh, there we go. First, select your state of residence. All right. Let's go to the Peachtree State. Yeah, look at this. 5 years, 1.55 jumbo rate is what, over $100,000 bucks? Yeah, over $100,000 bucks. So fixed annuities, 2 here. I mean, so I'm killing. So this is why, look at that. That's a 10-year annuity right there, 1.35. So I've doubled that with my scenario here. So why would you do a fixed annuity when you can do what I just did and guarantee that you're going to have at least your $100,000? You're not going to guarantee that you're going to have a return of 2.65 because we don't know what the markets are going to do. But that's locking up your money for 10 years for 1.35 when I'm pretty comfortable in what I just said. But it's always a risk. Anytime you invest in stocks, it's a risk, man. Guaranteed period. Look at that. Base rate. Okay, well, that's interesting. They got, I guess that's it. New York usually has better rates because the regulators in New York are more stringent. We used to have to deal with that at USA. Yeah, here you go. So New York, not much better. 10 basis points, so not much. Oh, there you go, man. Funds manager. Now just look at ETFs. All right, so anyway. That's how zero coupon bonds work. I love them. I'm a big fan of them. I think you should look into them for sure, especially if you're nervous about the market. If you're nervous about the market, a zero coupon can be a big opportunity for you. All right, we'll see you guys.